The White House called it a complete fabrication, yet oil still fell 5.5%. Iranian state television reported a draft memorandum of understanding in which Iran would normalize Strait of Hormuz shipping within 1 month. The White House denied the document's existence within hours. What makes today's price action difficult to read at face value is that the denial did not reverse the move. WTI settled near 88.68, its lowest since late April, and the S&P 500 closed at 7,520, a record. Markets priced a deal that was simultaneously denied by both the party claiming victory and the party granting it. The capital flow that produced this outcome was specific. Institutional energy holders rotated out of oil-linked positions as the Brent print fell through 92 toward 91.75. That selling pressure transferred directly into the rally. The S&P 500's marginal gain of 0.02% was carried almost entirely by technology and semiconductor names, not by broad cyclical re-rating. Secretary of State Rubio's phrase, "some progress," in negotiations, gave institutional desks just enough diplomatic signal to justify reducing energy overweights built during 4 months of Hormuz blockade. The question is whether that reduction was a positioning adjustment or the start of a full rotation out of the energy premium. Dallas Fed President Logan added a constraint the rally structure has not yet priced. If Hormuz does not reopen quickly, global energy consumption decelerates more significantly than the current $88 WTI level implies. The peace trade bought a $5 oil move in a single session. The scenario it has not bought is a world where negotiations collapse and oil reprices past 100. The S&P 500 at record levels while that scenario remains live means the equity market is treating the Hormuz resolution as more certain than the bond and energy markets are, and that gap is where the positioning pressure actually sits.
The oil drop explains why energy holders sold. It does not explain why semiconductor names led the equity bid. Marvell Technology reported record revenue for its fiscal first quarter of 2027 and raised its outlook for both fiscal 2027 and 2028, citing accelerating demand across its data center portfolio. The company sees custom chip revenue topping $10 billion by 2029. That figure matters less as a revenue forecast and more as a positioning signal. Sell-side desks that had been debating whether the AI infrastructure capex cycle would plateau in 2026 received a primary document answer that pushed the cycle's visible horizon out by 2 additional fiscal years. The repositioning that followed was institutional, not retail chasing momentum, but funds whose prior stance carried AI capex as a 2025-2026 event, now extending their holding horizon. Micron extended its rally to a market cap above $1 trillion the prior session, rising another 3.64% to $928. Applied Materials announced a chip packaging partnership with Broadcom on the EPYC platform. NVIDIA's CEO had already stated the prior week that the company runs in every cloud and every frontier AI build. The pattern is a supply chain bid, capital rotating within technology rather than into technology, with custom chip designers and advanced packaging suppliers taking the flow that commodity memory held before Micron's re-rating. Goldman Sachs raised its S&P 500 year-end target from 7,600 to 8,000, citing durable earnings growth even with geopolitical headwinds. That revision signals sell-side consensus has realigned with buy-side positioning rather than leading it. What the Marvell and Micron moves leave unresolved is duration. The chip bid is priced on capex commitment through 2028-2029. It is not priced on demand delivery within that window. If hyperscaler capital expenditure guidance revises down in the next earnings cycle, the 2-year horizon extension that repositioned institutional holders today becomes the precise reason their exit pressure concentrates.
The chip sector's extended capex horizon forces one question the current rally structure cannot answer. Where does the cash for a $75 billion IPO come from? SpaceX is targeting a June 12 NASDAQ listing at a $1.75 trillion valuation, the largest public debut in market history. U.S. funds are already building cash reserves in preparation for the SpaceX and OpenAI offerings. That cash building is not passive. It requires selling something. The fund positioning dynamic that accompanied today's record close, institutional rotation out of energy, continued bid in semiconductors, runs directly into a calendar event in 15 days that will demand liquidity from the same holder class. SpaceX's $11.4 billion in revenue from its S1, which the market has focused on less than the $2 trillion headline valuation, is the number that determines where the IPO price anchors relative to the initial ask. The Hormuz peace trade, the chip capex cycle, and the SpaceX IPO are operating on the same capital frame. Institutional holders in large-cap U.S. technology are simultaneously pricing a geopolitical resolution that lowers energy input costs, extending their semiconductor exposure on a 2-year capex horizon, and now facing a 15-day cash commitment deadline that concentrates their next decision. The S&P 500 at 7520 reflects all three as simultaneously constructive. Bank of America noted that U.S. equities may see a summer correction simply because there is no remaining margin to price additional positive surprises. The dominant reading today is that the chip cycle floor is real. Marvell's raised outlook and Micron's trillion-dollar re-rating represent primary earnings evidence, not sentiment, and that the Hormuz peace trade, even if partially fabricated, removed enough energy risk premium to give technology positioning room to expand. The verification benchmark is the June 12 SpaceX IPO pricing. If the deal prices above $1.75 trillion and draws institutional demand without visible selling pressure in MRVL, MU, or NVDA in the preceding week, the capital frame holds. If the SpaceX cash build forces net selling in semiconductor names before June 12, the same institutional holder who extended their chip horizon today becomes the source of the next correction, not because the thesis was wrong, but because the calendar forced the exit before the 2029 CapEx delivery arrived. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.